All right, this video is about the money market and bond prices. Now, strictly speaking, this is not something that is in your book. However, I actually added this to my notes section because of the fact that it has popped up on the AP test several times. And I've seen it as questions that, could pop up on your test. So we're adding it. Okay, so what we're talking about here is the money market. Remember, we had the supply and the demand for money, and so we talked about the supply of money is determined by the Federal Reserve. The demand for money is talking about the general public, and so as a result, that determines the interest rate that is set for short-term financial assets. So here's what this means for us. Well, when the Federal Reserve uses open market operations, the open market operations, remember, is that buying and selling of those treasury bills. This impacts the price of those treasury bills or any other bond out there that is issued by the Federal Reserve. So we got to talk about, okay, how does that impact the price? So first off, we got to look at its basic supply and demand here. So just like before when we talked about supply and demand, this is the price of the treasury bills or any other bond, okay? And then this is going to be, sorry, my little thing is in the way. This is going to be the quantity of T-bills, so the quantity of treasury bills that are out there. Now, the supply of treasury bills is determined by the federal government, because if you remember, treasury bills are basically loans to the U.S. Treasury. And so the federal government will decide on how money they're willing to offer, how much loans they need, basically. And so the supply of the treasury bill is not dependent upon the price of the treasury bill. So supply of treasury bills are actually a very vertical line. So it doesn't really matter what the treasury bill's price of the treasury bill is. The federal government will say, we want this many. We want people to buy, we're offering this many for sale, right? It's kind of weird to think of it that way because you're buying government debt. All right, the demand for T-bills, however, is based on how much the T-bill costs. So just like any other demand curve, it is a downward sloping line. So, because if you think about it, if it's going to cost me more to be able to get that T-bill, so it's going to cost me more to be able to own this financial asset, I don't want very many of them. But if it's cheaper to get that T-bill, okay, to get that financial asset, then I'm going to want a heck of a lot more of them, which is going to be down here. So if that's the case, okay, so that's what it looks like. What if the supply of T-bills shifts to the left? Okay, when the Federal Reserve buys T-bills, they're basically taking T-bills out of circulation. There's less T-bills out there for everybody else to buy. So the supply curve shifts to the left. And as we know, whenever there's a left shift in supply, gee, here's what happens. Here's our original equilibrium. Here's our new equilibrium. Price increases. So what would happen if the Federal Reserve sold T-bills? So if their Federal Reserve is pushing more T-bills out there, the supply curve is going to shift to the right. And what happens to the price of those T-bills? Look at that. The price went down. Okay. So general rule of thumb. When the interest rate decreases, so the interest rate on, when we talked about the interest rate in the money market and we talked about the interest rate on short-term financial assets, when the interest rate decreases, the price of the treasury bills increases. And vice versa. And this is kind of the explanation that I was going for, but shortcut is that if the interest rate in the money market goes up, the price of the T-bills goes down. When the interest rate in the money market goes down, the price of T-bills goes up. Hopefully that makes sense. All right, that's it for now. Thanks for watching.